So we'll look at the brief exercises that go with Learning Objective 3. And I'll start with 13. And so 13 has to do with the sales with the right of return. And basically they sold some CDs. I think the new edition of the text may have to switch that. They grant the right to return it. They have a normal rate of return of about 15%, and then they say by October 11th, so many of them will return. So these are totally normal journal entries. There's nothing new here. We booked the accounts receivable on the sale and the sales revenue on July 10th. That's when that's when they said they had recorded it. Cost of goods sold inventory. October 11th, you've got some sales returns and allowances. And the only really different thing here is that with the new revenue recognition standard, they want you to put any returns into a returned inventory account rather than just your old inventory account. Okay, so this brief exercise leaves this right here. It doesn't really get into estimating, well, the journal entries for estimating the future returns, but it does get us into what would happen next. So we had total sales of the 700, 15% expected to be returned. So there's your expected returns. 78,000 have been returned, and so these are the future returns you expect. In the exercises, we'll see how we account for that, but that's all the brief exercise does. Okay, so let's look at 14. 14 is, you're just sort of estimating the liability for refunds, so that's very similar to what we just did. So I won't take up time on that. Okay, so bill and hold. Bill and hold, these are accounted for. These are accounted for under a totally normally, because it would help if I could find it. Oh, here we go. 15, okay. Yeah. As long as the requirements are met. Bill and hold has to be at the request of the customer, so you have to meet all of the requirements. It has to be a good reason for it, and otherwise you cannot really book it as a sale. But if it meets the requirements, then the journal entries are just the normal ones that you would do for a sale. Okay, principal agent, this is 16. The main thing to keep in mind is that the agent only books the commission revenue. They do not book the total revenue. Companies have done that and gotten in trouble, which is why they go to the trouble of telling you this. So travel agents, Travel Inc. is the agent, Caribbean Cruise is the principal, but it's the Travel Inc. that gets all the money. They collect the cash, but it's not theirs, it's due to the cruise company. When they settle up with the cruise company, they're going to send them the cash based on the price less their commission. So they'll keep the $4,200. That's what they book as revenue. That's all the agent books as revenue. Okay, so 17, consignment. These are a little complicated, but if you keep your, if you don't get too flustered by them, they're not too bad. Basically, the consignor ships the merchandise to Gooch to, and it says Jansen pays the freight. Gooch pays some local advertising, and there's a commission involved, and so you just have to take it a piece at a time. And the good place to start is, what's the revenue from the consignment sales? Well, they tell you. By the year end, 60% had been sold for $21,500. So there's your revenue. Commission, 10% of that, so you get the commission expense, $21.50, advertising expense, and so the Gooch there is going to send Jensen a check for the $18,850, and Jensen will book the sales for that. Cost of goods sold, a little bit tricky. It's $13,200. When you're computing that, you have to remember the freight costs, which add to your inventory. So you get your inventory cost at 20 plus the freight, 22, 60% gives you $13,200. Okay. Um, Warranties, you get your assurance type warranty, which is part of the selling price, and then you've got your service type warranty, which is a separate performance obligation and is billed separately. So with this one, you're going to be booking your cash and sales revenue. That includes your warranty. Nothing new here with the cost of goods sold inventory. But for the assurance warranty, you're going to book the expected expense that goes along with that and the liability in the year when those sales have occurred. You're also going to book cash and unearned warranty revenue for the service type warranty, which will start up, in a couple of years or however that works out in this problem. Okay, and then where do all these things show up? You'd show the sales revenue and warranty expense on your income statement, and then the other accounts on your balance sheet. Okay, so that's kind of the brief exercises that go with learning Objective 3.